If you run an orthodontic practice in Australia, the financial demands are unlike most other businesses. Your equipment is expensive and highly specialized digital scanning technology, treatment planning software, bracket and wire systems, and sterilization equipment all represent significant capital outlay. Add the cost of fitting out a clinical space to the standards patients expect from a specialist practice, and you are looking at an investment that most lenders need to understand properly before they can help. Here is what is available to orthodontic practices, how it works, and what you can realistically borrow. Healthcare practices benefit from a lending environment that is generally more favorable than other industries. Orthodontists in particular have strong and predictable revenue profiles, low bad debt rates, and high patient lifetime value. Lenders with healthcare specializations understand this and are often willing to offer better terms and higher facilities than they would to a comparable non-healthcare business. For equipment purchases, digital scanners, cone beam CT systems, treatment chairs, autoclaves, and practice management software, equipment finance is typically the most appropriate structure. The equipment itself becomes the security, keeping your property free for other purposes. Rates are competitive and the tax treatment is often favorable, with depreciation and interest both potentially deductible. For practices investing in technology upgrades or expanding into a second treatment room, equipment finance handles these purchases cleanly. Unsecured business loans provide fast access to working capital for operational needs, marketing investment, additional staffing, or bridging the gap between a fit out and the practice reaching full patient capacity. You can borrow between $10,000 and $500,000 based on your practice revenue and bank statements with approval in 24 to 48 hours. For a well-established orthodontic practice with strong monthly revenue, the accessible loan amounts can be substantial. A business line of credit works well for practices managing variable patient volumes or seasonal fluctuations in treatment starts. You draw what you need, repay as revenue builds, and only pay interest on what you are using. For practices managing cash flow between high and low volume periods, a revolving facility provides more flexibility than a fixed term loan. For significant investments, purchasing a practice, undertaking a major fit out, or opening a new location, a secured business loan using property as collateral provides access to larger facilities at lower interest rates. Orthodontic practice acquisitions are a well understood lending category for specialist healthcare lenders, and competitive terms are available for qualified borrowers. How much you can borrow depends on your practice revenue, trading history, and the purpose of the finance. Established orthodontic practices with strong patient volumes and clean financials can typically access substantial facilities. Healthcare specialist lenders will often assess applications differently from generalist lenders, taking into account the stability of specialist practice revenue. Most applications can be completed online in under 20 minutes. A commercial finance broker with healthcare experience can identify the lenders most suited to your practice profile before you apply. Brokers are paid by the lender on settlement and do not charge you directly. Use the free business loan finder at Reliable Business Tools to find which loan type suits your orthodontic practice. 6 questions. A clear recommendation, no credit check, and no obligation.